Welcome to Finance Frontier, where we unpack the trends shaping the global economy. Today, we're diving into a topic that could reshape the financial world as we know it: BRICS' bold challenge to the US dollar. Former President Donald Trump recently issued a stark warning about this potential shift, stating, if BRICS creates a new currency or backs another to replace the mighty US dollar, they can wave goodbye to selling into the wonderful US economy. They can go find another sucker. His words, while provocative, highlight just how high the stakes are for the U.S. and global financial systems.
Trump's warning underscores the urgency of this moment. The BRICS coalition, Brazil, Russia, India, China, and South Africa, is actively working to reduce their reliance on the dollar. Whether through trade agreements in local currencies, alternative payment systems, or even a unified BRICS currency, their ambitions represent more than just economic independence. It's a direct challenge to a system that has been dominated by the U.S. for nearly a century.
Economist Peter Schiff adds another dimension to this debate. In a tweet that sparked widespread discussion, he claimed the U.S. has been trading real goods for paper dollars. BRICS might stop playing the sucker. Schiff's argument isn't just about BRICS, it's about the fragility of the U.S. economic system itself. If these nations succeed in reducing their dollar reliance, the consequences could ripple through global markets, disrupting trade, investments, and everyday life.
This isn't just about geopolitics, it's personal. If the dollar weakens, it could drive up inflation, making everything from electronics to groceries more expensive. At the same time, for investors, these shifts could open doors to new opportunities. Whether it's gold, emerging markets, or even cryptocurrencies, the changing financial landscape offers ways to both protect and grow wealth.
So what's at stake here? On one side, you have BRICS nations, representing over 40% of the world's population and nearly a quarter of global GDP, seeking to build a financial ecosystem outside U.S. influence. On the other, you have the U.S., whose economic dominance depends on the dollar's role as the global reserve currency. The tension between these forces could spark one of the most significant financial shifts of our time.
In today's episode, we'll unpack BRICS' strategy, their motivations, the tools they're using, and the challenges they face. We'll also explore what these developments mean for the US dollar, global markets, and most importantly, your investments. From Schiff's analysis to Trump's warnings, we'll break down the signals that every investor should be paying attention to.
And we won't stop there. We'll also dive into the opportunities this shift could create for savvy investors and the risks you need to watch out for. Is this the beginning of a new financial order, or will BRICS' ambitions falter under the weight of their own challenges? Let's find out together. Stay with us. Now that we've set the stage, let's dive into BRICS' strategy to reshape the global financial order. At the heart of their plan is a shared frustration with the dollar's dominance. For decades, the U.S. has enjoyed enormous economic advantages as the issuer of the world's reserve currency. But BRICS nations, Brazil, Russia, India, China, and South Africa, are saying enough is enough.
These countries have compelling reasons to push for de-dollarization. The dollar's dominance ties them to U.S. monetary policy, which often prioritizes domestic interests over global stability. When the Federal Reserve raises interest rates, for example, it can send shockwaves through emerging markets by increasing borrowing costs and weakening local currencies. By reducing their reliance on the dollar, BRICS nations aim to reclaim economic control.
Their strategy revolves around three main pillars. First, increasing trade in local currencies. BRICS members are signing bilateral agreements to settle transactions without the dollar. For instance, Russia and China already conduct significant trade in yuan and rubles. Second, they're building alternative financial systems like Russia's SPFS and China's CIPS, which bypass SWIFT, the dollar-dominated global payment network. Third, and perhaps most ambitiously, they're exploring the idea of a unified BRICS currency. But can they pull it off?
The challenges are immense. For starters, BRICS nations are far from homogeneous. China and India, the bloc's largest economies, have long-standing geopolitical tensions, including ongoing border disputes. Russia's economy, heavily reliant on energy exports, faces unique challenges compared to India's tech-driven growth. Even South Africa, the smallest BRICS economy, has priorities that don't always align with the group's larger goals.
And let's not forget the trust factor. A unified currency would require unprecedented cooperation and shared governance, which isn't easy when member nations have such different political and economic systems. But BRICS leaders seem undeterred. At their recent summit, they outlined plans to expand their development bank and deepen trade ties, a clear signal that they're serious about building a financial ecosystem that rivals the West.
Peter Schiff has a sharp take on this. He argues that BRICS isn't just about de-dollarization. It's about correcting what they see as an imbalance in global trade. His perspective is clear. The U.S. has been trading real goods for paper dollars. For BRICS, reducing reliance on the dollar is about reclaiming value they believe has been unfairly extracted by the current system.
Imagine the impact if BRICS succeeds, oil priced in yuan instead of dollars, major trade deals conducted in a BRICS-backed currency, and a financial system no longer centered around the U.S. dollar. These shifts wouldn't just weaken the dollar, they could fundamentally alter the global economic balance. Yet, such a dramatic change is anything but certain. Even within BRICS, skepticism looms over whether their ambitions can overcome the political and logistical challenges they face.
And that skepticism isn't unwarranted. The dollar's dominance isn't just about convenience. It's about trust, liquidity, and stability. Investors know they can rely on the US dollar during crises, as we saw during the 2008 financial meltdown. For BRICS to truly rival the dollar, they'd need to offer not just an alternative, but a better one. That's a monumental challenge.
Still, the very fact that BRICS is pursuing these goals signals a broader shift in the global financial landscape. Whether they succeed or not, their efforts are already influencing markets and forcing nations to rethink their reliance on the dollar. For investors, this is a story that demands attention.
In the next segment, we'll explore what BRICS moves mean for the US dollar. Could this truly be the beginning of the end for its dominance? Or will the dollar remain the cornerstone of global trade? Stay tuned.
Let's focus now on what BRICS de-dollarization strategy means for the US dollar. For decades, the dollar hasn't just been a currency, it's been a cornerstone of global finance, a safe haven in crises, and a powerful tool of American influence. But what happens if BRICS succeeds in undermining its dominance?
The dollar's strength lies in its role as the world's reserve currency. Over 60% of global foreign exchange reserves are held in dollars, and commodities like oil have been priced in dollars since the 1970s. This petrodollar system has given the U.S. significant advantages, from low borrowing costs to the ability to impose economic sanctions. But cracks are starting to show.
Economist Peter Schiff calls this system a house of cards. His view is that the U.S. has been living beyond its means, trading real goods for paper dollars. If trust in the dollar erodes, Schiff warns, the consequences could ripple across global markets. Imagine a world where oil is priced in yuan or a BRICS-backed currency. That would fundamentally reshape global trade and weaken demand for dollars.
A decline in the dollar's dominance could have severe consequences for the U.S. economy. First, it would increase borrowing costs. Foreign governments currently buy U.S. treasuries to hold their reserves in dollars, keeping demand high and interest rates low. If that demand falters, the U.S. would need to raise rates to attract buyers, making debt more expensive for everyone, from the federal government to homeowners.
And higher interest rates wouldn't just affect borrowing. They'd ripple through the economy, slowing growth and potentially triggering a recession. Meanwhile, a weaker dollar would drive up the cost of imports, fueling inflation. Everyday items, from electronics to groceries, could become significantly more expensive, putting pressure on American households.
The geopolitical implications are just as profound. The dollar's dominance gives the U.S. immense leverage on the world stage. It enables Washington to impose sanctions, control trade flows, and shape international policy. If BRICS succeeds in building an alternative financial system, it could erode that influence, limiting America's ability to project power globally.
But let's not forget the dollar's unique strengths. Its dominance isn't just a product of U.S. policy, it's built on decades of trust, deep liquidity, and unmatched stability. Even during crises, the world turns to the dollar. Take the 2008 financial meltdown, for example. As markets panicked, demand for US dollars surged because investors trusted its resilience.
That's the critical advantage BRICS would need to overcome. Creating a rival currency isn't just about printing money. It's about building an entire financial ecosystem that can rival the scale and stability of the dollar. While BRICS nations are making progress with initiatives like China's CIPS and Russia's SPFS, these systems are still far from achieving global adoption.
For now, the dollar remains the cornerstone of the global financial system. But that doesn't mean BRICS efforts are insignificant. Their moves to diversify reserves and reduce dollar reliance signal a broader shift that could reshape global markets over time. The question isn't whether the dollar will be dethroned tomorrow, it's whether this is the beginning of a long-term decline.
In the next segment, we'll explore how investors can navigate this shifting landscape. From commodities like gold to emerging markets and cryptocurrencies, we'll break down the strategies that can help you prepare for a world where the financial rules are changing. Stay with us.
With every challenge comes opportunity, and the financial shifts we're seeing now are no exception. For investors, BRICS de-dollarization efforts could open doors to new strategies and assets that thrive in this changing landscape. Let's explore how you can not only protect your wealth but position yourself for growth.
Let's start with gold, the classic safe haven. BRICS nations have been steadily increasing their gold reserves, with China and Russia leading the charge. These moves aren't just about hedging. They're a signal that gold is regaining prominence as a store of value in uncertain times. For individual investors, gold-backed ETFs, mutual funds, or even physical gold can serve as a hedge against inflation and currency volatility.
But gold is just one piece of the puzzle. Commodities as a whole are gaining attention as BRICS nations push to price trade in their own currencies. For example, Russia has proposed a BRICS grain exchange, and oil producers like Saudi Arabia are reportedly exploring pricing oil in yuan. If these moves take hold, they could create opportunities in commodity-focused ETFs or companies tied to these markets. The demand for energy and agricultural resources isn't going away, it's just shifting toward different pricing mechanisms.
Let's not overlook cryptocurrencies, which are becoming increasingly relevant in this shifting financial landscape. While Bitcoin and Ethereum remain divisive, they've steadily gained traction as alternatives to traditional currencies. BRICS nations are also exploring blockchain technology for cross-border payments, signaling their interest in decentralizing global finance. Peter Schiff may dismiss Bitcoin as digital fool's gold, but for many, digital currencies offer unique advantages: a hedge against inflation, a buffer from central bank policies, and decentralized control over assets. Investors with a high risk tolerance might consider this space, especially as blockchain solutions gain traction globally and the role of crypto in the evolving financial system becomes harder to ignore.
Emerging markets are perhaps the most compelling opportunity. BRICS nations are among the fastest growing economies in the world, with expanding middle classes and increasing digital infrastructure. India, for instance, is modernizing rapidly and becoming a global leader in tech innovation. Brazil is leveraging its agricultural dominance to secure its position in global trade. Diversified emerging market ETFs offer exposure to these trends while spreading out risk across multiple countries.
But while emerging markets offer growth potential, they're not without challenges. Political instability, regulatory hurdles, and currency fluctuations can create volatility. That's why diversification is critical. A balanced portfolio that includes commodities, emerging markets, and alternative assets like cryptocurrencies can help manage risk while capturing growth. Treasury inflation-protected securities, or TIPS, are another way to hedge against inflation in a shifting economic landscape.
And don't overlook defensive sectors like healthcare, utilities, and consumer staples. These industries tend to perform well during economic uncertainty, offering steady returns even as other markets fluctuate. Dividend-paying stocks in these sectors can also provide a reliable income stream. For example, companies in the utilities sector often see consistent demand, regardless of broader economic conditions.
The opportunities don't end there. As BRICS nations push to reshape global trade, other commodities like rare earth metals could gain strategic importance. These materials are essential for tech manufacturing and renewable energy, areas where BRICS countries, particularly China, play a major role. Investors may want to explore ETFs or funds focused on critical minerals as part of a long-term strategy.
Ultimately, the key is preparation. The financial rules are changing, and BRICS' efforts to challenge the dollar are just the beginning. By staying informed and strategically diversifying, you can turn these shifts into opportunities rather than setbacks. That brings us to the risks, because while opportunities abound, the road to de-dollarization is fraught with challenges.
In the next segment, we'll discuss the risks and counterarguments surrounding BRICS de-dollarization plans. From internal divisions to logistical hurdles, their path to success is far from guaranteed. Stay with us.
While BRICS' ambitions are bold, the road to de-dollarization is anything but straightforward. There are significant risks and challenges that could derail their plans, from internal divisions to logistical hurdles. Let's take a closer look at the counterarguments and why some experts believe the US dollar's dominance isn't going anywhere.
One of the biggest challenges facing BRICS is internal alignment. These nations have vastly different economic systems and priorities. China, for example, operates a highly centralized, state-controlled economy, while India's is more market-driven and democratic. Then there's Russia, whose reliance on energy exports makes its economy vulnerable to global price fluctuations. Aligning these diverse interests to create a unified financial strategy is no small feat.
And that's just the start. Geopolitical tensions within the bloc are another major obstacle. China and India, the two largest BRICS economies, have long-standing border disputes that have flared up multiple times in recent years. These conflicts make deep economic cooperation challenging. Even among smaller members like South Africa and Brazil, domestic issues often take precedence over regional or global ambitions.
Beyond internal divisions, there's the issue of trust. A unified BRICS currency, if it ever materializes, would require shared governance. But can these nations really trust one another enough to create and manage a joint monetary system? Historically, even alliances with less complexity have struggled to maintain cohesion. The Eurozone is a prime example. Despite shared values and governance, member nations have faced significant challenges in aligning fiscal policies.
Then there's the logistical side. Building an alternative to the dollar-dominated financial system isn't just about printing a new currency or creating new payment networks. It requires building trust with global investors, establishing liquidity, and ensuring stability, all while navigating the complexity of international trade agreements. This isn't something that happens overnight, it takes decades.
Let's also consider the dollar's unique position. It's not just a currency. It's a symbol of stability and trust that has been built over nearly a century. Even during major crises, the dollar remains the go-to safe haven. In 2008, when global markets were in turmoil, demand for the dollar surged because investors trusted it more than any other currency. For BRICS to rival that, they'd need to not just match, but surpass the dollar's track record.
And let's not forget about the global financial ecosystem. Over 60% of international reserves are held in dollars, and most global trade is still conducted in the greenback. This isn't just a matter of convenience, it's deeply entrenched in how the world does business. Transitioning away from the dollar would require massive shifts in trade policies, banking systems, and investor behavior. That's no small task.
Some critics argue that BRICS efforts could actually backfire. If they push too hard to create alternatives to the dollar, they risk fragmenting global trade systems, increasing transaction costs, and creating financial instability. In trying to bypass the dollar, they might end up making trade more complex and less efficient.
Peter Schiff has his own take on this. While he's critical of the U.S. economy's reliance on the dollar, he acknowledges that there's currently no other currency with the global trust and liquidity to replace it. He puts it bluntly, the dollar might be flawed, but it's still the least flawed option. That's a reality BRICS will need to contend with.
Ultimately, the biggest challenge for BRICS isn't just creating an alternative to the dollar. It's convincing the world to use it. And that brings us back to trust. Without a financial system that global investors, businesses, and governments can rely on, any alternative currency is unlikely to gain traction.
So, while BRICS ambitions are making waves, the dollar's dominance remains firmly entrenched for now. But that doesn't mean investors should ignore these trends. Even incremental changes in the financial system can create opportunities and risks. In our final segment, we'll explore how you can navigate this shifting landscape and prepare for what's next. As we wrap up this episode, it's clear that BRICS' efforts to challenge the US dollar are a story of both ambition and uncertainty. Their push for de-dollarization signals a broader shift in global finance, but it's a shift fraught with challenges, both internal and external. The question isn't just whether BRICS can succeed, it's how these efforts will reshape the financial landscape for all of us.
Let's start with what we know. BRICS nations are serious about reducing their reliance on the dollar, and they're backing that ambition with tangible steps. From increasing trade in local currencies to building alternative payment systems, their actions are already creating ripples in the global economy. For investors, these changes highlight the need to stay informed and adapt to evolving dynamics.
But as we discussed, the road to de-dollarization is far from smooth. Internal divisions, geopolitical tensions, and logistical hurdles present significant barriers. And while the dollar's dominance may be slowly eroding, its unique strengths, trust, liquidity, and stability continue to make it the cornerstone of global finance. For now, the dollar isn't going anywhere.
What does this mean for you as an investor? The key takeaway is simple. Change creates both risks and opportunities. By staying informed about the forces shaping global markets, you can turn potential disruptions into strategic advantages. Let's dive into some actionable steps to help you prepare. First, diversify your portfolio. The current financial landscape is anything but stable, and diversification is your best defense. Consider increasing your exposure to commodities like gold and silver. These assets have historically served as hedges against inflation and currency volatility, and with BRICS nations stockpiling gold, the trend is clear.
Second, look to emerging markets. BRICS economies, particularly India and Brazil, are experiencing rapid growth in key sectors like technology, infrastructure, and agriculture. Diversified emerging market ETFs can offer exposure to these opportunities while spreading out risks across multiple countries. Keep an eye on developments like Russia's proposed BRICS grain exchange, which could open new investment avenues.
Third, consider alternative assets like cryptocurrencies. While digital currencies remain polarizing, their potential as a hedge against traditional financial systems is growing. If BRICS nations integrate blockchain into their cross-border payment systems, it could drive further adoption of crypto. But remember, this is a high-risk space, so allocate accordingly.
Finally, don't overlook defensive sectors. Industries like healthcare, utilities, and consumer staples tend to weather economic uncertainty better than others. Dividend-paying stocks in these sectors can provide steady returns and a buffer against market volatility. These are the kind of assets that thrive regardless of what happens with BRICS or the dollar.
The financial landscape is shifting, but the key to navigating these changes is preparation. Stay informed, diversify your portfolio, and think strategically about long-term trends. Remember, every disruption brings both risks and opportunities. Your job as an investor is to position yourself on the winning side of that equation.
That's why resources like Finance Frontier are so important. We're here to help you make sense of these trends and turn complex challenges into actionable insights. Make sure to subscribe and follow us for updates on future episodes. We'll continue to decode the forces shaping global finance so you can stay ahead of the curve.
Thanks for joining us today. Until next time, stay informed, stay strategic, and remember, the future belongs to those who prepare for it.
Before we close, a quick reminder, the content we discussed today is for informational purposes only and does not constitute financial advice. At Finance Frontier, we aim to provide insights into market trends, but all investment decisions should be made after consulting a qualified financial advisor. Markets are dynamic, and risks can change rapidly.
The opinions expressed in this episode reflect those of the hosts and do not necessarily represent the views of our affiliates or sponsors. Past performance is not indicative of future results, and all investments carry risks, including the potential loss of principal. Always consider how this information applies to your unique financial situation.
This episode incorporated data and perspectives from reputable sources, including Bloomberg, Reuters, and expert commentary, to provide the most accurate and up-to-date analysis. However, listeners should continue to monitor developments and stay informed as markets evolve.
Thank you for listening to Finance Frontier. Music in this episode, including Not Without the Rest by Twin Musicom, is licensed under the Creative Commons Attribution 4.0 license. Finance Frontier Copyright 2024. Unauthorized reproduction or distribution is prohibited. We'll see you next time.